So is it better to buy a home or keep renting? It's a massive decision, and honestly, the answer is rarely simple. It depends on so many factors. So your personal finances, for example, market conditions, and even how long you plan to live in a property. But I'm not going to just talk about the theoretical. I'm going to actually crunch the numbers, and that's going to be numbers including stamp duty, solicitor fees, house price growth, investment returns to see when renting is better than buying and vice versa. And I'm also going to be tackling a few conventional wisdoms along the way and revealing some insight about investing in property. Now, one thing to point out is that I'm going to be looking at the purely financial aspect of buying a house versus renting. Buying a home is exactly that. You're buying a home, and there are lots of reasons why you would buy a property, but people often ask about just the financial part and whether now is a good time to buy their first home. Now, I am going to be bringing up a calculator on screen, which we will give you access to. We'll put a link in the notes of this video in due course so you can download a copy yourself and put your own scenarios into it. On screen, you can see the calculator we've built, and we'll run through some real world scenarios using historically accurate data for the UK to see exactly when renting is actually better than buying over certain time frames, and crucially when buying becomes the clear winner. The calculator looks at a comprehensive range of variables that influence your decision and the outcome. So let me quickly run through them because each one plays an important role. So first up, you've got property value, which is pretty self-explanatory. The deposit amount is the amount you're going to be putting down when you try and buy a property. The mortgage interest rate and term, these will dictate your monthly mortgage cost and will depend upon the amount you want to borrow as well as your deposit, of course. First time buyer status. Now this is important because it impacts the amount of stamp duty that you pay. First time buyers can pay less stamp duty in certain situations. Then we've got upfront buying costs, which are things like solicitors fees, mortgage arrangement fees and survey costs. And then we've got the ongoing cost of ownership, so things like annual maintenance costs, which are often overlooked. So that's things like repairs or you improving the property, something that you won't tend to do if you are renting. Then you've got the buildings insurance, so you'll need to have buildings insurance if you own a property, which you won't do if you are renting typically. Then there's the market dynamics that we include, so the annual house price increase, the annual rent increase, so if you're a renter, how much that's going to go up over the long term. And then finally, we've got the amount of interest that you can get, or the investment return you can get on money that you put away. So this is like the opportunity cost if you decide to keep renting rather than buying. And the comparison period, as I've already mentioned, that we can change at will. So of course we could put any data in this calculator and it will spit out a result at the bottom. So what it does, it will go through, analyze all that data. It will look at the analysis of buying, telling you the change in your net worth versus if you are renting. And then it will give you a difference at the end. If that number's negative at the bottom, then renting's better. If it's positive, then buying is better. So what we've done here is put in some averages for the values based on our research. So the property value for the first time buyer is going to be £270,000. We're going to change that. In this scenario, I'm going with somebody who's got no deposits. They're taking out a 100% mortgage. Typically, you're going to get 5.75% or somewhere near that. It could be a bit lower or a bit more on your mortgage rate. We're going to look at a mortgage term of 25 years. And solicitor fees, we're going to, throughout this analysis, we're going to use £1,500, mortgage arrangement fees of £1,000, survey costs of £600. Interestingly, annual maintenance costs, we put 2.8%, and that's of the initial property value. And that is roughly in line with what Checkatrade have found in their research that people spend on their property, 2.8% of the value every year in terms of maintenance. Building insurance is roughly around £300. Now, it goes without saying that if you rent and you could buy property where the mortgage is lower than your rental cost, then you are almost inevitably always going to be better off buying a property than renting it, assuming you can get the mortgage. So we're not going to look at that scenario. We're going to look at the scenario which some people will find more typical, where maybe their rent is less than the potential mortgage of the house they're going to buy. Now, we are using a 5% interest rate on any potential savings that you can put away. And I'm going to change that annual rent increase to 3% to match inflation. And I'm going to do an initial comparison period of 2 years. So this scenario, somebody who's a typical first-time buyer, and if they are only paying £900 a month in rent, they go and buy a property with the details I've said, £270,000 with no deposit. They may be looking at a mortgage of £1,698.59. It means that they could potentially, if they stayed renting, have nearly £800 left over. So their rent is lower by £800 than their monthly mortgage amount. So they have the ability to put that money into savings and that compound over time. So this is what the analysis looks at. Now, crucially, this scenario I'm also going to create is an environment like we've got now with the mortgage rates, but with a fairly stagnant property market. So the annual house price growth we're going to say is that house prices are going to just be flat. They're not going to go up. And we're only looking at a period of initially, let's say 2 years here. If we look at the 2-year time frame, then what will happen is that the buyer will be worse off over a 2-year period once they've bought, to the tune of nearly £6,500. Over 5 years, what will happen is that that will increase slightly to £7,500. And this is because they are not benefiting from an increase in equity in their home because they've got 100% mortgage. Now let's see what happens if we have a fairly low growth rate on property of about 1%. After 2 years in that scenario with a 1% growth rate on house prices, they would still be marginally better off had they stayed renting. But very quickly you will see, if we get to just 4 years, that number rapidly starts to increase into the positive where buying makes sense. And if we continue increasing that to 5 years, you can see the numbers go up to £6,000 into positive. By year 10, what will happen is they will be £30,000 better off. And this is really because the equity in their home is growing as house prices are growing. And if I increase that house price rate to something like 3%, which is a bit of a long-term average, you can see after 10 years already their equity has ramped up and they're going to be nearly £100,000 better off than somebody who'd stayed renting. Now, one of the big things is that it depends very much on the difference between your monthly rent as well. So if the monthly rent was pushed up towards what is a long-term average in the UK of 1,350, so 1,350, then what you see is they are so far worse off if they stayed renting than if they bought, because the differential is only a few £100s a month between their rent and the mortgage. So by buying a house, they're only about £350 worse off in terms of money that they can put away. Yes, if you rent, they can put that money away into savings, but their equity in their property is growing at a faster rate. So what I want to do now is just quickly knock that back to roughly £900 a month. So with that rent change, this is more in line with where I found myself when I bought my first house, and the numbers were fairly similar to this. And so in the long run, I ended up being able to be better off when I bought my first home. But I bought my first home just before the financial crisis. When I say just before, I'm talking about 2 or 3 months. See what happens when you get a little bit of negative equity. So we're not talking about much. We're talking about house prices falling 0.5% a year for a period of time. Now I'm going to knock this comparison period down to, say, 2 years. Now, what you see happens is, I'm just saying here that property prices are going to fall 0.5% for 2 years. And end of that 2-year period, we're looking at what's our net worth done? How has it changed? You can already see then that by buying at the wrong time, you were £9,000 worse off. And that's a scenario that many people found themselves in. And interestingly, there were places as recent as 2023 in the UK where the house price hadn't risen back above the level where it was before the financial crisis. It just shows you, if you're unlucky and get the timing wrong, then what will happen is that you could find yourself in negative equity. But then this is what happened to me. So let's just say you stayed somewhere for 14 years. Even in that scenario where house prices, and I've said they've continued to fall at 0.5% for 14 years in a row, which is possible. It has happened in the past. We've had extended periods, maybe not quite that long, but we've had significant falls. By having a repayment mortgage, you are still going to be net positive after a period of time to the tune of £7,000, even if house prices were slowly falling for that 14-year period. I've used 14 years because that's the period I lived in my first house. But obviously house prices don't always do that. So if we just put that back to even zero, then what you see, you are significantly better off. But then if we go back to putting that at about 2-3%, then what we see is very quickly you get significant amounts of equity in your home. So that is one danger of buying a property you have to be mindful of. You could end up in negative equity because of timing. But if you live somewhere long enough, then if the prices rise, then you should get out of negative equity. But even if they don't and you've got a repayment mortgage, then you still could get out of negative equity, and you could still be way better off than had you been renting. So I'm going to set up another scenario now. This is somebody who's got a 10% deposit. So they get a better rate on their mortgage. So if you look at the best mortgage rates in the market, they will get a rate of about 4.38%. We'll put a link in the notes to the best mortgage rates out there. And I'm going to put this back to a 2-year time frame we're looking at. And even keeping a typical 3% rise in house prices, don't forget your rent's going up by 3% a year. Even if you could put £400 a month into savings, paying 5% interest, which is a good rate that you could get now, you would still be better off by buying after 2 years. And if you extend that time frame to say 10 years, you can see how quickly your wealth starts to grow. £136,000 better off by buying under this scenario. But let me put in a scenario where property prices start to fall. You're unlucky like me and you buy just as the market starts to turn. Every time I buy a house, the market does seem to fall. It just seems to be slight bad luck. Now, assuming we're going to look at 2 years again, the first 2 years, because that's when people's mortgages come up and they often think about a 2-year time frame. Under that scenario of properties have fallen 1% for 2 years in a row, you will be marginally worse off by about £4,500 if you buy a house. You'd be better off just staying renting based on the assumptions that we've made. But then look how quickly the situation resolves itself. After 4 years, you've already dropped down. You're only £3,000 worse off. By the time you get to 10 years, this is still assuming that house prices are falling 1% a year. You very quickly get into positive territory by buying a property being better off to the tune of nearly £18,000. And that's because you are clearing more of your mortgage. You've got a bigger chunk of equity. You started with a bigger chunk with that deposit, and it increases as you pay it down. You get out of negative equity even quicker. So then if we put this back to a long-term average, we're talking about the annual house price rise to 3%, then you can see it's very significant that when you buy a house and you've got a significant deposit, that your wealth does grow more quickly if you buy. But the takeaway from this point is that that's why I would always buy a property with a repayment mortgage, which is really the only option you pretty much have these days, although there are now more interest-only mortgages becoming available. Back when I bought my first property at the financial crisis, you could get interest-only mortgages, but I bought with a repayment, despite seemingly everyone else doing interest-only, because I was mindful of the fact that if you have a repayment mortgage and you have a decent enough deposit, they protect you from negative equity and they keep your options open, so if you need to move, you are able to in the future. So people looking at this might think, well, buying properties a great investment, that's why it does better than maybe saving. And we're going to change the savings rate in a minute for money that you have in cash to see what happens in that particular scenario. But the reason why having money in property can suddenly accelerate your wealth is not because of the property itself necessarily. It's really down to the fact that you are using something called leverage. So the UK economy is set up and you're able to borrow money at scale and invest in property. You can't invest in other things, but you can borrow money at scale, multiples of 6 times your salary, and buy a property. So that's why when property prices go up, even just a small amount, when I've been playing with these calculators, suddenly your wealth accelerates, because it's the percentage on the total property value that is working on. And you, in fact, even if you only got a small amount of equity, you are using leverage to amplify your returns. But it's also why when prices fall, that you can see your wealth decline significantly, and renting ends up being the better option. So if you learn one thing from this video, when people talk about property as a great investment, it's leverage that's doing most of the lifting, that's making you more wealthy. Now, I want to do a third scenario, and this is going to be somebody who is perhaps living in London, who has quite a hefty deposit. So it's somebody who's got a bit of money. If I change the numbers and put the house price to £450,000, and let's say they do have a 10% deposit, I'm going to change the annual house price growth to 1%. That reflects what we've seen in recent history. That's something I want to come back onto later. And I'm going to put the rent a little bit higher towards that national average of 1350. Again, we could put whatever we want into this, but I'm just going to use some average numbers. Yes, that might be a bit low for a rental property in London, but it just gives you a scenario. And I'm going to have the rent increase by 2% a year, and I'm going to have that 5% in savings. Then what you see if we move this to 2 years is that someone in London after 2 years will be better off renting, because that short period of time they've got a higher mortgage rate. You see the mortgage leapt to £2,200 versus their existing rent. So the person who's able to save at 5% is increasing their wealth over that period of time, and they haven't benefited from a significant amount of house price increases, only at 1%, which has been in line with what we've seen recently in London. The other thing to bear in mind is they've had to pay more in terms of stamp duty when they bought the property because of the property value. Now look what happens when you look over a 5-year time frame. So put that in, and then suddenly buying looks much more attractive. It's almost £14,000 they're better off after a 5-year period. But notice how much their wealth increases in the next 5 years to the 10-year time frame. Suddenly it's gone to £51,000. That's a massive jump, and it's because they are now benefiting from that combination of reducing their mortgage, so they've got more equity, but also that compounding effect on that significant house price. And so it does mean that that's why we see patterns where people might buy in somewhere like London and then start to move further out. We saw a lot of that obviously in the pandemic for various reasons, but we've seen the continued pattern of that where people use that geo arbitrage, so they might grow their wealth in one area and then move elsewhere to release some of that equity. But of course, it all depends on what property prices will do, because again, in the opposite way, if property prices start to fall, maybe you've bought a flat that isn't particularly desirable and you can't sell it for so much, and I'm just saying over that period house prices fall by 1% a year, then suddenly you are on a significant loss compared to renting. So yes, you could just stay in the property and hope that prices increase or pay off your mortgage over the long term before you sell, but you would be worse off versus renting. Now, I want to close this off because I could be here all day showing different scenarios, but I want to show you a scenario where somebody definitely would be better off renting over the long term. And I'm going to call this person just a wealthy investor. I'm going to change the deposit to 100,000. So they've got a lump sum that they could choose to buy a property with, or they could instead decide to invest that money and carry on renting. And the difference between their mortgage and the rent they're paying now, which I'm going to assume is lower, so I'm going to put that rent down to £900 a month, that they could as well invest that. And we're going to assume a better investment return. We assume savings, but let's assume they get 8% a year. Maybe they're taking a bit more risk investing in something that's more diversified, including equities. And I'm even going to knock up the house price growth to 3%. What you find happens is they will be over a 10-year time frame £56,000 better off if they'd stayed renting. And if we extend that to 20 years, you can see the numbers grow even more. And so suddenly they would have been more than £250,000 better off staying renting. So why is that? And again, it's because they are not using leverage as much, because they've got a much bigger deposit, and they're also getting a better rate of return because they're investing over the long term. This person has decided, I don't need my money in 5 years. I'm going to invest for the long term, just rent and invest my money. And then they could decide at the end to buy a property if they wanted. Of course, there are some assumptions in here that the rent is only £900 a month. Would somebody who's got £100,000 really live somewhere where they would only pay £900 if they could afford more? I'm assuming the annual rate of increase is only 2% on rental. So yes, there's lots of assumptions that we can play with, but there are scenarios, that's the message, where you could for the long term be better off if you rented. So is that a realistic scenario? Maybe not. Some people may be lucky enough to be able to live with family members, or there may be a family member who's a landlord who gives them a pretty low rental property to live in for an extended period of time. But it just goes to show that there are scenarios where you can be better off if you rent. But the most likely thing is that you will probably be better off if you buy, if house prices continue to go up. But the point is, there are scenarios where you can argue for either way. Typically, buying will increase your wealth over time because of that thing called leverage. Now, it does raise the question about the house price growth. That is crucial to a lot of this. Now, are you going to be unlucky? Is now a good time to buy, for example? That is a difficult question, but one thing I wanted to draw people's attention to is a bit of research by Rathbones. I'll put a link to the research in the notes of this video, but Rathbones have stated that the golden age of UK property investment is likely to be over for various reasons that I'm not going to go into, including reasons of government policy. But there is a suggestion that I just want to pull out, that the rise in house prices over the recent years, so from 2016, has only been 1.3% a year in London, so less than you probably would have thought, which is why I used the example earlier. I was only putting a relatively low growth rate. So if we can't guarantee that house prices are going to go up, then that means it could massively impact those wealth calculations. But it does also reiterate one of the big things that I always try and tell people is not to rely on property just to grow your wealth for a pension, for example. So a home is a home, it's where you would want to live, and banking on your property to increase your wealth over time, yes, it may happen, but it does limit your options, because you will have to, for example, downsize or borrow money out of your property, again, via things like equity release, but it does limit your options. So something to bear in mind, you're probably never going to time the market. You can't necessarily think you're going to get the rates that people have done in the past, but hopefully we've shed some light on the important things to think about when you're trying to buy a property and whether you're going to get on the property ladder.